Back in May, I talked about how the foreclosure wave had really started in earnest, right? The mid year numbers just landed. 227,000 homes entered foreclosure in the last 6 months, and that's up 21%. And the banks are moving faster than they have since 2013. Here's the full story and how to tell if your loan type is the one going first.
Back in May, we told you the foreclosure wave had begun. We were early, and there is no satisfaction in it. 2 weeks ago, the 6 month numbers landed, and they came in worse than we said. 227,548 American homes received a foreclosure filing in the first half of this year. That is one in every 632 houses in the country. Filings are up 21% on last year and 28% on the year before that. And the banks are finishing these cases faster than they have since 2013. Tonight, you are going to see the size of it, the one line on your mortgage statement that is actually driving it, and exactly which kind of loan is going under first. Start with the shape of the thing. 164,000 homes entered the foreclosure process in 6 months, up 18% in a year. That is 66% above the first half of 2020, which matters because in the spring of that year, the government simply halted foreclosures outright. The artificial floor is gone, and we are well above it. Lenders took full possession of just under 28,000 homes, up a third in a year. The number I keep coming back to is the timeline. The average foreclosure completed this spring had been in the process for 563 days. That is the fastest since 2013, and it is down 13% in a single year. When a pipeline starts clearing faster, everything being finished now was filed a year ago, which means the next batch of completed foreclosures is already inside the system, and nothing anybody does this month changes that. Now I want to give you the strongest argument against everything I just said because it comes from the people who published the data. Rob Barber runs Adam, the firm that produced these numbers. His words in the release were that foreclosure activity continued to increase, but the broader picture remains one of the market gradually returning to more typical patterns. He called it a continued normalization, and he has a case. Completed repossessions are still down 26% from the first half of 2020. One in 632 homes is nowhere near 2008, when it ran many times that. And delinquency on conventional loans, the ordinary kind with a real down payment behind it, actually fell last quarter. There is one more, and it is the fairest one. Borrowers who get put into a required trial payment plan are still counted as delinquent until a permanent arrangement is signed. A point made by Marina Walsh, who runs industry analysis at the Mortgage Bankers Association. So part of the spike is a family doing exactly what the servicer asked, sitting inside a category labeled delinquent. All of that is true, and I am not going to pretend otherwise. Here is what survives it. Normalization describes an average, and this average is made of two completely different groups of people. So let me show you the line that separates them, because it is not the interest rate. If you have a mortgage and you did not put 20% down, you almost certainly have an escrow account. It works like this. On top of the money you pay the lender, your servicer collects extra every month and holds it to pay two bills on your behalf: your property taxes and your homeowner's insurance. Once a year, they add up what those bills actually came to, compare it against what they collected, and adjust your monthly payment to match, which means a fixed rate mortgage was never a fixed monthly payment. You locked the interest, you did not lock the two fastest rising costs in American housing, and they sit on top of your loan inside an account you have probably never opened. Look at what those two bills did. Property taxes averaged $3,018 a year in 2024, up more than 27% from 2019. Homeowners insurance has climbed 46% since 2021. In one servicer study across roughly 1.2 million loans, found the average annual premium went from about $1,600 to just over $2,600 in 4 years. Together, taxes and insurance now make up about a fifth of the typical monthly mortgage payment, and in some markets, more than a third of the entire bill. Rising escrow is one of the biggest risks in housing this year in the assessment of the analytics firm Cotality. Their figure is that roughly 65% of escrow accounts are running short, with an average shortfall of about $2,150. Spread across 12 months, that is another $175 a month on a payment somebody already told you was fixed. And notice who is exposed.
Hey, real quick, just to jump in, if you want to take advantage of this foreclosure cycle, you need to learn about the real estate cycles and where we are right now and what's coming next. I put together a bundle of courses, an insane deal. It's called the Real Estate Crash Bundle. Links down below. You will take it. It's a video course. You will walk away completely changed and thinking differently and acting differently to take advantage of this. So links down below. Now let's get back to the video.
Escrow is mandatory for the people who could not put 20% down, which is nearly every first-time buyer in the country, which brings us to the part that answers the whole question. Delinquency splits sharply by loan type in the Mortgage Bankers Association's quarterly survey, and the gap is not subtle. Conventional loans, the 20% down kind, sat at 2.75% this spring, and that number went down. Loans insured by the Federal Housing Administration, the low down payment program first-time buyers use, sat at 11.88%. And it rose 126 basis points in a year, which is about 1.25 percentage points. Walsh put the spread between them at roughly 900 basis points, meaning 9 full percentage points, and called it the widest since 2021. Read that as plainly as it can be said. About 1 in 8 borrowers on an FHA loan is behind on payments. Among conventional borrowers, it is closer to 1 in 36. The reason is arithmetic, not character. An FHA buyer put 3.5% down, often at 2021 or 2022 prices. They have almost no equity. Their escrow is not optional, and the emergency options the FHA built during the pandemic, the partial claims and the long modifications, expired at the end of September last year. So the buffer disappeared at the exact moment the bill went up. Walsh also noted delinquent FHA and VA loans moving into the later stages and into foreclosure, which is the sentence that ties her data to Adams. That gap between 11.88 and 2.75 is not a housing statistic. It is a map of who could absorb a rising bill and who could not. Look at where it lands. Florida has the worst rate in the country, 1 in every 373 homes, with filings up about a third in a year. Punta Gorda sits at 0.5% of all housing units. Lakeland is just behind it, then Columbia, South Carolina, then Cape Coral and Cleveland. South Carolina is the second worst state and Indiana the third. But the rates are not the signal. The acceleration is. The biggest annual jumps in foreclosure starts were Idaho at 59%, Colorado at 57%, Georgia at 52%, North Carolina at 47%, and Mississippi at 45%. Not one of those is among the states with the worst rates today. That is a map of where this is going, not where it has been. Texas and Florida still lead on raw volume at roughly 20,700 and 20,300 starts each. Here is the clock. The next delinquency survey lands in the middle of August. Watch one number in it. If FHA delinquency breaks 12%, the back half of this year is tracking worse than the front half. And the wave runs on a schedule, which is the part almost nobody says out loud. Escrow analyses go out in winter, mostly January and February. So the next round of payment shocks is not a forecast. It is already calculated and it is sitting in a queue. So open the envelope nobody opens. Find your annual escrow analysis. It shows what your servicer collected, what the bills actually came to, and how they arrived at your new payment. Read the tax line and the insurance line separately, because they move for different reasons. If the tax line jumped, your county reassessed, and every county has an appeals process with a deadline attached. If the insurance line jumped, that policy is reshoppable every year, and most people never do it. Federal rules cap the cushion a servicer may hold at roughly 2 months of payments. So if yours is holding more, ask why in writing. And if you are already behind, Understand the trap sitting inside that data. You can be in a trial payment plan doing exactly what you were told to do and still be counted as delinquent. Silence from a servicer does not mean you are fine. Talk to them and talk to a housing counselor because your file is not a national average and I am not the person who can read it for you. Back in May, we said the wave had begun and plenty of people told us we were early. 227,000 filings later, 1 in every 632 houses in this country. Nobody is arguing about whether it started. The banks answered that already by clearing cases faster than they have in 13 years. Nobody loses a house all at once. It goes one annual statement at a time, sent by a company you never chose, about 2 bills you cannot negotiate. So I want to hear from you. If you bought on an FHA loan in 2021 or 2022, what has happened to your escrow payment since? The foreclosure wave doesn't knock the house down. It drains the escrow account, one repriced line item at a time. Economic Ninja is out.